Hey everyone, today we're jumping right into the fascinating world of corporate ownership. We're going to be looking at a really important accounting standard called IFRS 10. It's basically the official rulebook that defines who really controls a company. And, as you're about to see, the answer isn't always what you'd expect.
So let's kick things off with a pretty basic question, right? How do you know if one company actually owns another? I think for most of us, the immediate answer is, well, they own more than half the shares. Duh. And for a long, long time, that was pretty much the rule. But what if I told you that under today's rules, you could control a massive corporation with just 48% of the shares, maybe even less? Yeah, that's exactly what we're going to unpack here.
All right, to get to the bottom of all this, we're going to walk through 5 key things. We'll start with why we even bother combining company financials in the first place. Then we'll get into the absolute game changer, the principle of control. We'll break down its 3 pillars, explore some of the really interesting gray areas, and then we'll cover a major exception to the rule. Okay, first up, this idea of consolidation. Now, all this means is taking the financial statements of a bunch of companies and smushing them into one single report. But why do it? Well, the whole point is to give investors and everyone else a true, complete picture of the economic reality of a group of companies, not just a bunch of separate, fragmented pieces. So the main players in this drama are the parent company and the subsidiary. Pretty straightforward. The parent is the one in charge, and the subsidiary is the company that's being controlled. It sounds simple, but trust me, all the magic and all the complexity is wrapped up in that one little word, controls. So here's the bottom line. When a parent controls a subsidiary, IFRS 10 says you have to present their financials as if they're one giant company. This is so important because it stops companies from, hiding debt or really bad performance in some obscure subsidiary that's technically a separate legal entity. It gives us a much more honest look at the entire group's financial health.
And that leads us right to the absolute heart of IFRS 10, the principle of control. This standard was a huge deal because it basically threw out the old, rigid, just count the votes rule and brought in this much more thoughtful concept that looks at what the relationship is really like in substance.
Okay, this is the official definition, straight from the standard itself. I know it looks a little dense and wordy, but it's really built on 3 core ideas that we're about to make super clear. Having power, being exposed to variable returns, and, this is key, having the ability to use that power to affect those returns. And this sentence right here perfectly captures the big shift in thinking. So forget about just counting the shares. That's the old way. The only question that matters now under IFRS 10 is this: does the investor actually have control? Everything, every single assessment comes down to that one principle. So how do we actually figure out if someone has control? Well, the standard gives us a really helpful checklist. It's like a 3-part test, and an investor has to meet all 3 criteria at the same time to be considered in control. We call them the 3 pillars. And here they are. First, you need power over the other company. Second, you have to have exposure to its variable returns. And third, you need the ability to use your power to actually influence those returns. You need all 3, no exceptions. Let's dig into each one.
Pillar number 1 is power. And we're not talking about some vague influence here. This is about having the current, existing right to make the big decisions that really matter, the ones that are going to significantly impact the company's bottom line. It's all about who can actually call the shots on the big stuff right here, right now.
Next up, Pillar 2 is returns. The investor can't just be some manager getting a fixed salary. Nope, they have to have skin in the game. Their own financial results have to be tied to how well that subsidiary does. And this isn't just about the good stuff, like dividends or a rising share price. It also means being exposed to the potential losses if things go south.
And finally, Pillar 3 is the link. This is what connects power and returns. It's making sure that the investor is actually using their decision-making power for their own benefit. If they're just acting as an agent for someone else, say, like a fund manager making decisions for their clients, then they don't have control in the eyes of IFRS 10. They're not the one ultimately benefiting.
Okay, this is where things get really interesting. Let's dig a bit deeper into that first pillar, power. Because, and this is the crazy part, it can exist even when you don't own a majority of the votes. This is where you have to put on your detective hat and look beyond the numbers. So check out this classic example. You've got investor A who holds 48% of a company. That's not a majority, right? But now look at the rest of the shareholders. There are thousands of them, and each one owns this tiny little fraction of a percent.
I mean, what are the odds that they're all going to get together and organize a vote against investor A? Practically zero. So in reality, even without 51%, investor A has what we call de facto control. They can run the show because nobody can realistically stop them.
To figure this all out, you also have to be able to tell the difference between real power and, well, what amounts to an emergency brake. Substantive rights are the ones that give you the practical ability to actually steer the ship. These grant true power. On the other hand, protective rights are just there as a safety net. Think about a bank that lends a company a ton of money. The bank might have the right to veto the sale of a major asset, but they're not involved in the day-to-day running of the company. They're just protecting their loan. That's a shield, not a steering wheel. All right, so just when you think you've got this all figured out, IFRS 10 throws us a curveball. There's a major exception to the rule. A special type of company that, even when it totally controls its subsidiaries, is actually exempt from consolidating them.
And these special companies are called investment entities. A great way to think about these are things like venture capital funds, private equity funds, or even mutual funds. Their entire business model is just to buy, hold, and eventually sell investments to make a profit. They're not trying to operate these companies as part of some larger industrial empire.
Now, to qualify for this special treatment, a company has to meet 3 pretty strict criteria. First, it has to be in the business of professional investment management. Second, its whole reason for existing has to be about generating returns from either capital growth or investment income. And third, and this is a big one, it has to measure its investments at their current market value, or what we call fair value.
And here's the massive consequence of all that. Instead of consolidating, rolling up all the assets, all the liabilities of the companies it controls, an investment entity just reports them at their fair value. Fair value is just the current market price, what you could sell that investment for today. Any change in that value goes straight to the income statement. And for someone investing in a fund like this, that's actually way more useful information. They get to see a real-time market value of their holdings, not the nitty-gritty operational details of dozens of different companies. So let's wrap this all up. If there is one thing you take away from all this, it should be this. Under IFRS 10, corporate control is not a simple numbers game anymore. It's all about the substance and the reality of the situation. The entire assessment boils down to that 3-part test. Does an investor have the power to call the shots? Do they have skin in the game with variable returns? And are they using that power for their own benefit?
And that leaves us with one final thought to chew on. Now that you know the real rules of the game, take another look at some of the companies you follow. Are there any with big, but not majority shareholders that might actually be the ones pulling all the strings behind the scenes? The answer might just change how you view that entire company. Thanks for tuning in.